Alright, so welcome back everyone. This is episode 2 of What's in My Portfolio. This is a series that I'm currently doing, which is going over all of my holdings in my portfolio, going over what made me invest into these certain companies that I hold, how long I'll hold on to these positions, and my future outlooks for the companies that I own. So in today's video, we'll be going over my next position, which is Amazon. So I actually invested alongside this with Google. I both invested in Amazon and Google around the same time. And so far this position has been great. This has been a winner in my portfolio. And I still expect it to grow exponentially later on in the future. So firstly, looking at Amazon real quick, you can see the market cap is around 2.4 trillion. It's a pretty big company. If you look at the PE ratio for Amazon, it's relatively pretty high because there's a lot of investors pricing in high growth potential for this company. So essentially you're paying a premium to own a piece of the company because there's high growth potential being priced in from investors. If we look at the free cash flow yield, it's also trading at a premium. This is likely due to Amazon investing in more capital expenditures like infrastructure, AI expansion, etc., which we'll get into later in the video as well. If we look at the price to book ratio for Amazon, it's around 7.8. A high PB ratio indicates strong asset growth potential. This is again being priced in from investors. This isn't guaranteed, but this is just what investors are pricing into Amazon stock. If you look at the price for Amazon stock, it's around the same level as where it was earlier this year. If I expand to the 10-year time frame for Amazon stock, you can see that over the 10 years, this company has returned around 25% in share return potential each year. If you look at the revenue graph for Amazon, this is an amazing graph. Like I said, you always want to see a graph like this for revenue. For every company you look at, this is clearly exponentially growing. If you look at the past 10 years, it's growing around 20%. So on average, revenue is growing around 20% each year. If you look at the 5 years, it's still maintaining that high growth potential as well. It's slowly maturing, but still growing. It's still growing pretty high, actually. Every year, it seems like Amazon is likely to push the revenue higher and higher and higher. So that's really good for any company you want to look at. All right, if we dig deeper on the revenue by segment, their main driver of revenue is their first-party online sales. And if you don't know what their first-party online sales is, it's basically where Amazon themselves buys the product and then sells it themselves on the Amazon store. Their second source of revenue is third-party seller services, which is basically like Amazon FBA, where they basically help other companies sell their own products. And in exchange, Amazon receives a commission, a fee, or a subscription, or whatever. They basically make money off of other people selling their own stuff. Their third, in my opinion, has really, really high growth potential compared to first-party and third-party online services, is AWS. AWS has super high growth potential and really high margins as well. They've been growing their margins significantly. They've been growing their customer base significantly, which we'll get into right now. So this is specifically what I wanted to go over to showcase how strong and how much growth potential there is with AWS. This is their customer commitments, and it's been growing significantly within the past 7 years. If you guys don't know what their customer commitments is, it's basically customer contracts for AWS with multi-year terms. So each time this number is growing, it basically means that AWS is able to make big deal customer contracts with big players who want to use AWS. And if you just look at their 5-year CAGR growth rate, this is another strength that AWS has that proves they're able to scale significantly and honestly grow to being their own mini company within a big company. So this graph is able to show my optimism for AWS. It's just able to show their growing exponential customer base. Now, if you look at their AWS year-over-year growth rate, you can see it's slowly maturing. AWS is more of a mature revenue segment now. However, it has gone down significantly in 2022 due to macro tightening. However, it's able to grow a little bit due to AI expansion and more LLMs being used within 2023 to 2024. I think this is when GPT-4 came out. So basically, this is when there was another phase of AI expansion. So we will probably see more slower, mature growth within AWS because it's more of a mature segment within Amazon. But as long as AI is growing and there's more need for computing, AWS is definitely going to be relevant just with more mature numbers in the future. So if we look at the AWS operating margins, this is another graph that just shows my optimistic and opportunistic view on AWS. It shows moderate expansion around 28% each year from the past 2 years. So it just shows you that they're improving their margins significantly. And that's very good for AWS, because not only they're making more money each year, but alongside that, if they're able to increase their margins, they'll just dramatically increase their revenue with AWS as well. Within the next 10 years, I could honestly see the AWS being its second source of revenue, if not the biggest source of revenue for Amazon. So I'm very optimistic for AWS. I think it's going to be the next big powerhouse for Amazon, and it's going to be able to make Amazon relevant within the future. Now, the reason why operating margins for Amazon increased is because they've invested more into infrastructure efficiency. They made custom silicone chips, which basically lower the cost of computing significantly and also increase the throughput for AWS. So this increased the margins a lot for Amazon. Customers also used more high margin services within AWS. So my prediction on AWS operating margin will be a little bit of a moderate expansion. I think it would be capped around 40%. Now I'm going to go over the free cash flow for Amazon. Now I want to point out that since Amazon constantly reinvests into capital expenditure and infrastructure constantly, you're going to see this free cash flow look a lot cyclical. It's going to be a cyclical free cash flow model. You're going to have times where they generate a lot of cash. They basically hoard their cash, and then they reinvest, and then that reinvestment pays off, and then they reinvest again, and then they just do it all over again. So you're going to see this huge flywheel of constant reinvestments paying off, cash hoarding, and then doing it all over again. So knowing that Amazon is constantly reinvesting into their company, I'm not going to look at free cash flow, or I'm not going to rely on free cash flow per share significantly. Instead, I'll rely more on EPS, earnings per share. And if you look at their EPS, they have maintained super high growth. I mean, for the past 5 years, they have managed to grow 40% each year on average for their EPS, which is insanely good for Amazon. All right, so now looking at the balance sheet for Amazon, I'm going to first go over their debt. So looking at Amazon's debt, the reason why they issued more debt recently is to fund more heavy CapEx projects like AI infrastructure, AWS, network expansion, etc. Now, I don't really mind Amazon using all this debt since they can easily pay it off with their cash alone, but I look at the debt interest coverage. And what that basically means is the debt interest divided by operating income. And if we look at the debt interest coverage on my paper, I don't have it on my computer, but it shows that the debt interest coverage is around 34x, which basically means that the operating income for Amazon is 34 times more than its interest on debt. So not only they could easily pay off the debt on their cash, but they could also easily pay off the interest on their debt from their operating income. This just shows that Amazon is able to use their debt properly. They're very disciplined in terms of debt. They want to pay it off fully. They want to know if they could pay off the interest, and etc. Now, if we look at the cash for Amazon, it's been growing significantly well. They're able to survive recessions. They're able to survive any hiccups within macro conditions or geopolitical conditions. Since they have a large amount of cash on hand, they're able to cover themselves for uncertainty and unpredictable outcomes in the world. So if we look at the return on capital for Amazon, they don't issue dividends at all, and they rarely buy back stock. However, in 2022, they issued a $10 billion stock buyback program, but they've only done a little bit of that $10 billion. So there's still a lot more buybacks to be done in the future. They personally do it when they think their stock is significantly undervalued, which is why they bought it in 2022 when it was down a lot. So you're going to see more buybacks more periodically, not consistently. And that kind of reflects on the shares outstanding. Since they're not doing consistent buybacks, they're constantly kind of diluting shareholders, which is the only downside I have for Amazon, but it's not really significant in terms of dilution per year. If you look at the past 10 years, it's only diluting shareholders 1.5% each year. That's not really a bad negative sign for this company. All right, so looking at the return on capital employed, I just want to show you that this is rising significantly due to the reinvestments they made earlier in 2022. They're paying off. Now, looking at the operating margins for Amazon, I want to specifically show the operating margins because if you look at the 2022 margins, it was around 1.8%. But if you look at 2025, it grew to 11.8%. So that's almost like 10x. That's literally 10x from where it was in 2022. So overall, I would say from a price to earnings perspective and a free cash flow yield perspective, Amazon is currently trading at a premium. Now, I'm not saying it's overvalued, but I am saying it's more expensive to buy a piece of this company than it was before. To determine overvaluation and undervaluation, we'll look at the DCF calculator and just run some tests real quick. Now, since I said free cash flow is not really a reliable metric for Amazon since they're constantly reinvesting into CapEx projects, I'll look into earnings instead. So it says from the last year, it's grown around 49.2% for EPS. I would just be very conservative and put a 20% growth rate. And their PE is currently at a 35, around almost a 36. So I would be even more conservative and just put a 30. That gives us around a 15.19% return every year for the next 5 years. And the entry price needed for an annual 15% return will be $200 to $27 per share. Right now it's currently at $225 per share. So from very, very, very conservative metrics, it's fair valued. If we want to be more optimistic and maybe say it will grow at around 25% growth rate, we're looking at around 20% annual growth for the next 5 years. The entry price needed for a 15% return would have to be $280 per share. So this right here shows that it's significantly undervalued still. Now I'm going to quickly go over ROE for Amazon, which is the return on equity. It has been growing consistently each year and it's maintaining around a 24% ROE, which just shows you that Amazon is able to produce enough capital and return on their investments from shareholder equity. Now, if we look at Amazon's return on invested capital, you can see they're maintaining around a 15.5% ROIC, which is really good. And what I usually do is I look at Amazon's weighted average cost of capital, which is around 7.6%. And I subtract that from its ROIC, which is around 15.5%. And if it gives me a positive number from the output, it just shows you that Amazon is able to create value. So 15 minus 7, that obviously leaves a positive number in the end. So that just shows you that Amazon's able to create value within the company. Next, I want to show you a visual real quick of the e-commerce market share that Amazon has. Right now, they're at 49.1% of the market share for e-commerce. And you might be thinking their next competitor might have, 20 to 25, maybe 30% of the market share. Their next competitor, which is eBay, only has 6.6% of the market share. That's so low. That's almost nothing. That's nothing compared to Amazon. So, and this is from 2018. So we could obviously assume that it's been growing a lot more since then. And if you look at the growth rate, it's able to grow significantly each year. So it probably has more of a market share for e-commerce now than it did in 2018. Lastly, I want to show the market share of cloud computing companies. And you can see that AWS has a third of the entire market share for cloud computing. This just shows you that in terms of cloud computing, Amazon is also dominating that sector as well, alongside with e-commerce. All right, so that's about it for this video. I hope you guys enjoyed, and I'll see you guys in the next one.